why averaging down is a bad idea. So let's go.
For more than 20 years. And there are some common questions that I get every time the market goes into a bit of a choppy period or maybe into a new downtrend. And one of these is about averaging down. Now, I want to pause here for just a second and admit that averaging down, it is actually going to make a little bit of kind of intuitive sense. And I think one of the reasons for this, even though it is almost always going to be a bad idea, and I'll make my case for this, not everybody's going to agree with me, but the data actually backs me up on this. It's almost always going to be a bad idea, but it feels like a good idea. And I think the reason for this is going back to investor psychology. Investors, most of us anyway, we feel worse about a loser than we feel good about a winner of proportional size. Why that is, I don't know that I can explain it, but it does work to kind of sabotage our trading performance if we're not aware of it. So let's talk about what averaging down is so we can really understand, well, why is this a bad idea? And I'll do it through a scenario. So let's say that you make an initial purchase in a stock, and to keep our numbers nice and even, I'm just going to say that we bought 100 shares of some stock at $100 per share. Now, subsequent to that, the stock drops to $90. We all hate it when that happens, but it happens nonetheless. So we're sitting on top of a $10 per share loss. So what averaging down means is that at that point, an investor might say, well, I'm going to buy more shares. Maybe I'll buy an equal portion. So I'll buy another 100 shares at $90. Well, what that has done is it's reduced the average purchase price because you bought 100 at $100 and you bought 100 at 90. So now your average purchase price is $95. And here's where we get to where it makes some kind of intuitive sense. It has an appeal in that my average, so my loss here used to be $10 per share, but now my average loss is actually only $5 per share, which seems like magic. And on top of that, I mean, it makes a lot more sense for a stock only has to come back $5 per share in order to get me to break even now, rather than $10 per share in order to get me back to break even. I think this is why the idea has a certain appeal. Here's the problem though. What we're talking about are averages, and we're not talking about the actual money at risk, the actual loss. So let's imagine in the first case that you invested into 100 shares. That means you made a $10,000 investment. And the second time around, you made a $9,000 investment. So your real loss is still $1,000. Sure, your average loss has dropped, but that's not your real loss. Your real loss is still $1,000 regardless.
Yes, and let's do some real world examples of this on everybody's favorite stock, at least on the YouTube pump and dump sphere. On AMD, right? Imagine, because it's now an $82 stock, which when we started covering it, I think it was a $150 stock. Anyway, so let's say, for example, you watched AMD fall all the way and you were like, oh, finally, I can scoopy exactly at $100. Let me buy as much as I possibly can. I'm such a genius here, right? And let's even label this. So like 100 shares. Oh man, we're geniuses, right? Perfect. And then AMD drops and you're like, oh crap. Okay, well, you know, I'm already losing on the trade. So you know what? I think I know better than the market. The market may be telling me that it's going down, but we're going to buy another 100 shares. We're going to buy another 100 shares at 90. So therefore, our average price is 95 right here. Perfect. Good to go. But to his point exactly, and this is a channel called Learning Markets, only 4.8 thousand subs. By the way, this video was suggested to us from our Discord, so thank you for doing that. Great channel. I did subscribe, so you should too. Point is, you're still sitting on a loss, and not only are you still sitting on a loss, it's still the same dollar loss. You're still down $1,000, like he's saying, but now you have even more of it. So you've now started throwing good money after bad money, right? This was already bad money, and now you're throwing good money after it. And then, not only that, but you're still losing, right? You're still losing. You were fine at 100, and then it came down, and you bought more at 90. And you're like, well, I'm losing here. I guess I'll continue losing down here. And that's why Paul Tudor Jones, one of the greatest traders of all time, has this saying: losers average losers. Mark Minervini. There's no shame on losing money on a stock, but to hold onto a loss and let it get bigger and bigger, or even buy more, is amateurish and self-destructive, right? This averaging down doesn't work. And we're going to continue. We're going to learn a lot about this today. But keep in mind, if you bought 100 shares here and 100 shares here while it's crashing down, your average price would still be the same if you bought 100 shares here and 100 shares here as it's crashing up. Wow. It's a crazy idea. And I keep reiterating this point because I think a lot of people right now are throwing all their money they possibly can into the market if they have any left. I mean, they certainly probably don't have any left at this point. but they're throwing more money at it saying, oh, I have to buy it now as it's getting cheaper and cheaper and cheaper. My bros, my like 8% of women who watch this show, buy it on the way up and you still get the same average price. You still get the same average price. So let's continue on with this video here.
Regardless of the amount of money that you actually put into the trade. So what we've done here effectively is we've increased our position size from $10,000 to $19,000 in my example. Well, this is actually a trap. Becoming overweight in a single position like this is a trap that even institutional investors fall into. It's very tempting, and depending on your investment strategy, is something we have to be aware of to avoid, because what we're essentially doing is negating a lot of the benefits that we get from diversification. So, for example, when we think about the cons of averaging down, this is the first one I would put on my list, which is we become overweight to an individual stock. As I said, this is something that even institutional investors kind of fall prey to as well. In fact, I can think of some style ETFs. There's a innovation ETF, the symbol's ARK, that invests very heavily in Tesla to the point where it's such a large percentage of the overall portfolio that the ETF basically acts like Tesla. So it doesn't have a lot of diversification benefit. The second thing here is we have to ask ourselves, well, where's the source of funds for this second, third, fourth, or fifth purchase when we're at?
Good point. Like I was saying a minute ago, right? If you've already bought into this all the way down, you probably don't have a lot left, even buy with, as it's down here. I'll never forget, there was a comment on one of the videos, and the person said something like, all I wanted to do was make $1,000 in SoFi, and now I have to make 2,000 just to get back to that 1,000 that I wanted to make. Yeah, it's really brutal if you aren't managing your risk. And then to his first point right there, overweight into a single stock. There was a point in time in my trading career when even when I was buying into stocks on the way up, right, as something was crashing up, let's use Palantir, for example. Even if I had caught this trend and it was doing really, really well, I would then average up my whole way. And this is not for longer term investing where you're doing it every 2 weeks. Like, let's say you're following the 50 moving average. Every 2 weeks, you just buy in as it's over the 50 moving average. We're talking about trading here. I would average up, but in process of doing that, I would get really, really, really overweight into a single stock. And then if it came back like this, I would actually end up with a loser because I'd averaged up so much that even a small pullback really took me out. So if you are looking at a longer term perspective, let's say you're following just a 50 period moving average, right? Every 2 weeks or so, as it's going up, you could absolutely layer in the whole way. But if you're trying to do something in like 10 days or 2 weeks or something, you're more likely to get whipsawed, which is what happened to me, which is why when I go into a trade, I go in with my full position size because I don't have additional funds coming in every 2 weeks like a paycheck to throw at it, right? I'm going in with my size, and that's what my size is going to be. But yeah, that's two different approaches here. I do want to point that out. But you want to be even averaging up in a long-term investment versus averaging down on a long-term investment, because we really don't know how much further it's going to go down and down and down and down.
Averaging down. Are those funds being taken away from winning positions, maybe liquidating winning positions, or is it cash on the sidelines? These are larger portfolio management problems. They don't really have, it's telling us that we're not using our capital very efficiently if we have money to push into losing trades that we're not pushing into either winning trades or into new positions with upside potential. And that would also increase our diversification benefit. And finally, value is hard to identify. It's what we're all after, but none of us have a crystal ball. We're going to look at stocks, and strictly speaking, the fair value of a stock is its current share price.
Now, oh my gosh, yes. Literally, the video right before this, I said specifically that because we covered a video this morning where the guy was like, the price is trading at $100 and the fair value is 122, so it's got 22% upside. And I said specifically exactly this. I said the fair value is what you can transact it today, which is what he just said. So yes, I love it. 10 out of 10 for me.
Now, all of us, myself included, we still do our best to try to identify, well, when is a stock maybe a little undervalued? Can we put the odds a little bit further in our favor? But we have to go into that with our eyes wide open, knowing that most of the time we're maybe going to be even with our estimate. Some of the time we might be able to hit it right, and some of the time we're going to be wrong. Well, I have to say, if a stock is in a downtrend already, and to the point where we're considering averaging down, that's giving me a pretty good clue that there's a lot of investors who think that the value there is lower. So what do I know that the rest of the market does not? Well, probably not very much.
And this is where the hubris of these people on the YouTubes really comes into play, especially on the Joker's channel, because you'll see him be like, oh, it has to go up from here. My analysis is saying that the price should be the most dangerous word in finance. The price should be whatever, right? And so you're anchoring yourself to this price. And if the price isn't hit, you're finding more and more reasons to justify why, it should be at that price. It doesn't have to be this way. Man, I'm loving this channel. By the way, dude's a CFA. I know a lot of CFAs, and that is effing hard to get. I didn't even try because the people who have CFAs talk about just how miserable life is while you're trying to get the CFA. Just putting that out there.
Now, there's an alternative to averaging down, and that is averaging up. In fact, sometimes investors call this pyramiding, which can mean a couple of different things, but that's how I've heard this referred to as well. And I think it makes some sense. So the idea here is a little bit different than averaging down, because averaging down means that you may or may not actually be increasing your position if the stock goes up. And you don't know whether you'll be increasing your position because you don't know if it's going to be going down. So averaging up, you enter the trade with the intent to increase your position if the stock goes up, which is what you would like from the stock in the first place. So the idea here is the trends are persistent in the market. So the same con in the case of averaging down works in our favor. The stocks that are in an uptrend have a tendency to remain in an uptrend. And stocks that are in a downtrend, they have a slightly greater chance of remaining in a downtrend than suddenly reversing as well. Number two.
And to that point, this is what I tell you all the time. Trends change. Trends change. But you want to be on the right side of the trend, and you can measure the trend, and you know where to measure the trend. It's with the 10 over the 20, price over the 50. When the 10's under the 20, price is under the 50, that's a downtrend. And we can go to the same stock at a different period in time, and we can see the 10 over the 20, price over the 50, and that's an uptrend. It's not all that hard. It's really not all that hard to decide where the trend is right now. Right. Even we don't have the Nancy Pelosi plan. Not yet. Not yet, at least. The 3.0 is going to be pretty close to it, but not quite yet. Even here, we don't know where in this white space the bottom will happen and it will start going up. We don't know the date of that, but we do know what we're looking for to see. That's when the 10, 20, 50 is all across the opposite direction. And to his point right here, trends do change, right? This is a perfect example, right? The trend actually did pop up in this case. There was a bullish trend right here. But remember, you've got 40% of the market, 40% of the move is due to the market, 30% the sector, and 30% the stock itself. And in this case, even though it popped up right here, it still had 70% of the outside forces moving against it right here. And that's a lot of the reason why it continued to push down.
Two, it's a lot easier for us to plan our maximum exposure because we're increasing our position as the stock rises, which is what we wanted to happen in the first place. So we are leaving our position a little underweight if the stock is not going the way that we wanted. The averaging down instead is doing the opposite of what we would be planning to do with averaging up. And then finally, this basically means that we've got a strategy that is maximizing our exposure to bullish stocks, which is generally what we want to actually do. Let's look at a quick example of this. I've got one with Microsoft, and I'm going to go back in time just a little bit. Let's say that an investor were interested in Microsoft. It's recently drawn down a little bit, and they want to add it to their portfolio. Started to bounce, so they decide, okay, I'm going to average up into this trade, which means that, yeah, my average purchase price is going to go up, but what I'm trying to do is to get in behind that bullish momentum. So let's say that they plan their first purchase at $320, and they invest, let's say, a third of the capital that they would maximally want to allocate to a position in Microsoft. Then if the stock continues to rise and it breaks short-term resistance, they may add another third of their maximum position size if it crosses $350. And then they may add another third if it gets to the next benchmark. Let's say that's $370 to the upside. So it's not very complicated. It's just a investor basically trying to get in light and see if momentum confirms this full position size in the portfolio. So what does the data actually say? Well, this is not a difficult concept for us to be able to test. And there have been some excellent studies done comparing averaging up or pyramiding with averaging down. And they show that averaging up outperforms averaging down by 3-to-1. Which kind of makes sense if you think about the fact that, again, trends in the market are persistent. So if you're investing with momentum, you should be putting the odds materially in your favor compared with investing against momentum, which is what you're doing when you're averaging down. But what about just averaging up or pyramiding versus just investing a lump sum? So your maximum position size in a particular position just all at once, rather than picking arbitrary technical benchmarks to add to your position.
Okay, so he might tell me how stupid I am. We'll have to see.
There's been some interesting studies done on that as well. And they also show that lump sum investing outperforms averaging up. Now, some of that has to do with just the efficiency of being able.
Wait. Did he just say lump sum investing outperforms averaging up? Let's go. Let's go. Mr. Olympia right here. Let's go. Let's go. I've been around the block a couple times. Okay. I think I know what I'm doing at this point.
Able to get those trades and a little bit to do with costs. But either way, it shows that you're not at a disadvantage if you are just investing all at once versus a more elaborate strategy like averaging up. So in that respect, we could probably look at things like dollar cost averaging, which is not a bad idea, or averaging up, which I don't think is a bad idea either, as being more or less neutral compared to a strategy where you're just deploying your maximum investment all at once. It may come down to investor preference, where it might be easier for them to deploy a strategy like that in their portfolio and to remain consistent rather than a more elaborate entry strategy like averaging up or dollar cost averaging. Now, I'm going to summarize knowing that I'll get some objections, and I don't think I'm being unfair if I summarize them as some form of, but I like this stock, I believe in it, or I think it's the future, or this is a good business model, whatever.
Okay, to those points, right? Yeah, I like the stocks. The CEO is great. I believe that it's going to go somewhere in the future. All that can remain. All that can remain. And you know where I'm going here. Okay, get my props ready. Hang on. All that can be true, right? And you can have all these amazing reasons why the stock can have a higher price, right? But, and maybe he's about to say, because if he says this, I'm gonna poop my pants. I'm gonna be so excited, right? Because all of these things can happen, but at the end of the day, only price pays. Only price pays. It can be the greatest stock in the world, but the worst in its price. And then eventually, it might come back up. It might. Because all stocks are bad. All stocks are bad. All stocks are bad. But every once in a while, they act right. Every once in a while, they act right.
Well, I certainly don't object to investors buying stocks they believe in. Frankly, there's some investors out there with specialized industry knowledge who may know a lot more about an industry and a stock that is falling than I would, and more power to them. I think it's important, however, for us to go into investments like that clear-eyed and knowing that, well, when we're buying a stock that is dropping, we are increasing the risk in our portfolio. So therefore, our overall portfolio management should account for that. So we don't get in a position where suddenly our capital is restricted or we don't have the ability to profit overall because we've been chasing a bad stock to the downside. It's been driven by emotional needs not to recognize a loss rather than a clear-eyed view of, well, I know what I'm getting into and I think I'm okay taking additional risk.
Great video. Fantastic video. So let's talk more about this. Let's talk more about this concept, right? So Johnny in our Discord, Johnny, I hope you're watching live. Let's say someone, no names needed, started dollar cost averaging into a stock that had already been falling for a while. Let's say they invested $1,000 every time the stock dropped by 5%. In total, they invested $1,000. So invest 100 every time it drops 5% to 1,000. So 10 times, it sounds like. But because the stock kept falling, by the time it hit the bottom, the total value of the investment was only $725. That's a 27.5% drawdown. Now, for the portfolio to just break even, it needs to grow by roughly 38%. So let's work on the math here, right? So let's find AMD being down 27.5, right? Let's find a point where it was down 27.5. Oh, that wasn't very hard to find. All right, so about right there. So from January of this year, January 23rd to now, AMD is down about 27.5. Okay. Now it needs to go up by about 38% to get back to break even. It needs to go up about 38% to get back to break even. And that's because in a stock, it can only go down 100%. If it goes down 100%, it's gone, right? But it can go up multi-hundreds of percent. So that's why losses work against you geometrically more than winners do. Okay. So here's a quick little graphic on what this means. Where is it? Here it is. So for example, a 20% loss requires a 25% gain to get back to break even. A 50% loss requires a 100% gain to get back to break even. So a $10 stock dropping to 5 now has to double. It has to go up 100% to go back to 10. Okay. So all that out of the way, let's get back over here. So even if the stock eventually recovers to the original DCA starting point, the investor ends up with about $2,000, assuming they continued investing another $1,000 during the recovery. Okay, so if it started to go up, they somehow magically had more funds. Now compare this to a more disciplined approach. Let's say the investor waited for a confirmed bottom, like using the 10, 20, 50 EMA setup, or any solid signal or solid reversal signal, With the same $2,000 capital, they could enter in 6 chunks of 333 after the trend turned. That could grow into something like 2450, significantly better. These numbers are synthetic and amplified, but the principle stands, and there's even worse cases. Imagine dollar cost averaging into AMD from top to bottom. The bottom may not even be in yet. So, Johnny, I really appreciate you taking the time to put all this out. And then Mark had a reply to it. So, Mark, like I say, smartest man I know. Side note, dollar cost averaging was originally intended as a regular interval investment strategy for broadly diversified index funds. Like I was talking about earlier, if you are investing in something, maybe following the 50-day moving average, right? You can add in every 2 weeks. It's very different than taking your full boat and being like, oh, I'm gonna get in here, but if it doesn't work, I'm gonna somehow find more, and then I'm gonna average down, and then I'm gonna average down. No. It's like if you're investing every other week on your paycheck regularly, and it's going up, and it's above its 50-day moving average, you can invest all the way up here, right? Invest all the way up. Because these will regularly cull their losers and replace with better performing constituents. So that's what he's talking about in the market averages rather than on an individual stock. It's still not perfect protection, nothing is. But unless you have a literal insider info, DCA into individual stocks is madness. I would venture to guess most who DCA in the way certain individuals describe are not similarly rebalancing on their portfolio and cap size. It amounts to bad math, like Johnny points out above. Let's see. Then there was over here in the, this is upcoming video ideas, or was it questions from you? Hang on. There's more. But wait, there's more. Here we go. DCA has become synonymous with buy the dip. And I think that's the problem. Here's a hypothetical. Both buying points A and B have 11% return at point C. Okay. So let's say, for example, let's do this. So this is the SPY. This is in 2024. This is around July to August 2024. Okay. If you invested here and here, okay, so 2 points in time, basically the same DCA. I shouldn't say DCA, basically the same price, 553. Both quick, they would both have 11% return at C, right? So imagine where's C? I don't know if we can get 11% here, but we'll just do that, 5.89. Right, so we're using real numbers here on a real chart to describe this hypothetical. Both could constitute dollar cost averaging. In this case, we know that we have a favorable outcome, 1 and 2, but in real time, we don't know this. What he's trying to say is that, like, in the moment, we don't have any idea what's going to happen next because we're looking at it in the past. But one of these things is not like the other. One of these things is trending down, and one of these things is trending up. Right? We can see that right here. The 10's under the 20. Price ended up under the 50 a couple days later, but still, this is what I would have avoided bigly. Come over here. Knowing this outcome, which entry would you have preferred? There's an opportunity cost between point A and B. Exactly. Right? So while this did recover pretty quickly, there was still time where you could have done something else with those funds. There was still time where you could have invested into something else and made a return. So that's the opportunity cost he's talking about. Now imagine this is on a longer time frame. Let's go to something that we know would be on a longer time frame, like CSCO, Cisco Systems. Let's go to a monthly chart. Okay. This is an example that I pulled out on this morning's live stream. It has never recovered this high set in March 2000. Never, not once. And if you were dollar cost average the whole way, you still wouldn't be back up because it's at 54 right now, and that high was at 82. 82. So I used another example right here, where it had a peak and then it took it 10 years from 2007, 2017 to come back. That's what he's trying to say is that we don't know. We don't know how much further the dip will go. We do not know that point. Let's assume AMD has a massive recovery, however long it takes. Would you prefer to buy during the recovery or over the course of a 50% drawdown in the recent months? Would you prefer to buy as it's going down and waiting and hoping and praying that you finally got in at a good price and that's going to start going back up, or buy on this side of the curve when it actually is going up and it's a lot easier to sleep at night? You don't have to worry about everything like you are on the way down. Getting to the point, you can DCA on the way up with the same outcome or possibly better, but with reduced drawdowns and without the same opportunity costs. But buying the dip is just gambling. So let's use Cisco as an example. Let's say you bought the dip on, and again, in the meantime, right, in the process, we don't know how far it's going to go. We don't know how far. No. Let's go to AMD because it's still trending down really strong, right? It's still trending down. Let's go to the daily chart, right? If we're getting in, remove all annotations. If we're getting in at 130, at 120, and magically we still have enough to get in at 110 and at 100 and at 90, and somehow we were able to come up with all these funds. During this time, there have been plenty of other opportunities of things that you could have bought. That's the opportunity cost that we're losing out on here. And if it does eventually go back up, let's say it goes back up right away, some huge recovery, you will be profitable faster by having bought on this side of the curve rather than this side of the curve, right? This is from December to now. I mean, what is that? Like 5 months? 5 months of down versus waiting until it hits its bottom, uses the outlier trend template and turns around, and then you can get in and you're profitable faster. Now, of course, the trends bend. We know the trends bend at some point, but at least you're into the profitability stage that much faster rather than jumping in as it's falling off a cliff, buying stocks while they're crashing down versus buying stocks while they're crashing up. All stocks are bad, but some of them are on the right foot. Yeah, exactly. Exactly. Joseph says, market manipulation with fake news, thanks to all kinds of stuff. You don't know that waiting for the market to go back up will yield results. Oh, I know that it will yield results. I know it will yield results, but the problem is we don't know how far it will go down. But we do know when it's trending upward versus when it's trending downward. And like I say, you're going to get to profitability that much faster. Kevin, super informative. I think I did watch a video from that YouTube channel a long time ago, which I didn't have much time or interest to act. That's all right, my friend. You're in the right place today. So this is what I wanted to show you here real quick. And before you head out, be sure you head over to outlierdeal.com where you can register to win $1,000 and a free year of Outlier, a $200 swag pack, or a $150 swag pack, plus the book bundle for the second and third place runners up. Well, I should say first runner up and second runner up. And be sure you come back tomorrow where outliers like us will save time, make money, and start winning with less risk together as a team. Now, YouTube is going to pop up a couple recommended videos. I recommend you watch them, and I also recommend you have a fantastic day. We'll talk soon.